Hello guys, welcome to Bhavna's Online Academy. In this video, we are going to see all the questions of AS23 which is there in your ICI study material or your examples, your illustrations as well as your practical or test your knowledge questions. So before you watch this part 2 which is covering your questions, please make sure to watch the part 1 which covers all your concepts where I have taught you all the concepts related to AS23 and also have told you about the question related points. So please make sure to watch that part first before you start watching this video. Okay, yes, so now let's start with the questions of AS23. So starting with your example 1 where they say that A Limited has 70% holding in C Limited. So there is A Limited which is holding 70% in C Limited, and then there is B Limited which is holding 28% in the same company. That means B Limited is also holding 28% in C Limited. Okay, so they are asking what will be the relationship here. So A Limited is holding 70% in C Limited, which means it is holding 51% or more in C Limited. So any company which is holding 51% or more will become its subsidiary company. So here A Limited will become the parent company and C Limited is going to become the subsidiary company because the holding is 51% or more. Whereas if you see the case of B Limited and C Limited, B Limited is holding only 28% in C Limited, which means it is holding only 20% or more, but less than 50%. Okay, but up to 50% only. So in this case, it is going to become an associate company. So here if you see, A Limited is having a majority holding which is more than 50%, so it will become the parent company. Okay, whereas B Limited is holding more than 20% but not more than 50%. So it cannot become a subsidiary company because it is not more than 50, it is only more than 20. So in such case, it is going to become an associate company. So here A Limited and C Limited are parent and holding in subsidiary company, and C Limited and B Limited are associate company. I hope you understood this. Next, let's move on to example number 2. Let's move on to example number 2. Here they are saying that A Limited is holding 90% share in B Limited. So A is holding 90% share in B Limited and then 10% share in C Limited. So it is holding 10% in C Limited. Then they are saying that B Limited is holding 11% share in C Limited. So B Limited is holding 11% share in C Limited. So they are asking what will be the relationship now. So if you see, A is holding 90% in B Limited. So here what will happen? Since A is holding 90% in B Limited, A and B will become parent and subsidiary company. Okay. And then what happens is A Limited is holding how much? 10% in C Limited, and B Limited is holding around 11% in C Limited. So here now you have to see what is the relationship between A and C. So A and C, if you have to see how much is A directly holding in C, it is directly holding 10% here. Okay. And then how much is A indirectly holding in C? Through B, because B is A's subsidiary company and B is holding 11% in C. That means A is indirectly holding how much? Indirectly holding 11%. A's own share is 10% and A's subsidiary is holding 11% in C Limited, which means 21% it is holding in C Limited, which is more than 20%. So here A Limited and C Limited will become the associate company. This is in the case of standalone financial statements. Okay, you remember I told you here. So in standalone financial statements, you do own company plus subsidiary company share. This is in standalone financial statements. But when it comes to consolidated financial statement, what you have to do? You have to take the own company share. You have to do plus what is the share of subsidiary company multiplied by what is the share of parent company and subsidiary company. So here what you have to do is, this is in SFS. If now they tell you to find out CFS, what you have to do is, you have to take the own share, which means directly how much is A Limited holding in C Limited, it is 10%. Plus indirect share, how you have to take is, you have to see how much is B Limited holding in C Limited. So indirectly, how much is B holding in C? It is holding 11%. And then you have to multiply it with how much is A holding in B. A is holding how much? 90% in B. So you have to do 10% is what A is holding directly. 11% is what its A subsidiary is holding. But how much is A holding in the subsidiary? 90%. So it is going to be 11% into 0.9, which is 9.9 percentage. So this is going to be 10 percentage plus 9.9 percentage. It's going to be 19.9 percentage in CFS. So this is the CFS holding. So if you see here, as far as the relationship between A and C is concerned, A Limited is having a direct and indirect holding of 21 percentage that we found here. Okay, so this is an associate company. Whereas if you see for the purpose of consolidated financial statement, it is going to be 19.9 percentage, which we found here. So this is how you find out both. Okay, I hope these both examples are clear to you. Now let's start with illustration number 1, where they tell you that there is A Limited which is holding 45% in B Limited. Okay, so A is holding 45% in B Limited, and the price paid was 15 lakh rupees. To get this 45%, A paid how much? 15 lakh rupees is what A has paid. Okay, and then they have given that balance sheet extract of B Limited. So in B Limited's balance sheet, all these are given. What is there? Paid up equity, share capital, securities premium, reserves, and surplus. By adding all of this, what you can find? You can find the net assets. You can find the net assets. This is what the point I told in concept notes also, right? So if you see here, how will you find the net assets? It is paid up equity share capital plus securities premium plus accumulated profits plus reserves and surplus. So you have to add the equity share capital, securities premium, reserves and surplus. So this is 16 lakh rupees. So this is the net assets of B. This is the net assets of B. So by giving 15 lakh rupees to B, how much net assets has A got in return? How much net assets has A got in return? A has got 16 lakh multiplied by 45% share in it, it has got. So 16 lakh into 45%, it is going to be 7.2 lakh. So which means A gave 15 lakh rupees to B. Okay, and in turn it got a share of how much? It got a share of how much? 7.2 lakh rupees. But here see, A has paid more and got less share. That means what is the extra amount? So 15 lakh it has paid, 7.2 lakh rupees it has got as net assets. 7.8 lakh is the adjusting figure. Why has A paid out 7.8 lakh rupees more? This it has paid for its goodwill. This it has paid for its goodwill that the A has got. Okay, I hope you understood this. Then they have told that during the year, B Limited had a net profit of 3 lakh rupees and it also paid a dividend of 1 lakh rupee. Okay, so and then they are telling you that you have to calculate what is the amount of investment in B Limited that should be shown in the consolidated balance sheet. Okay, so that means they are asking you what should be the carrying amount of investment. What should be the carrying amount of investment is what you have to find out. So how do you find it out? I told you, no, the two steps by how you find out. First, what you have to do, you have to find out the calculation of goodwill or capital reserve. Then you have to find out the carrying amount of investment. For goodwill or capital reserve, what you do, you see what is the amount paid for investment in associate minus pre-acquisition dividend. You will get the cost of investment. From that, you have to less the share of value in net assets, share in value of net assets, and you will get your goodwill or capital reserve. Okay, then here then you have to find out your carrying amount. First let's do this calculation. Okay, first let's find out the goodwill or capital reserve. So here what you do, see, first you have calculated goodwill or capital reserve. First you have what you have to take as our book. So we have to take as per my format that I've given. It is amount paid, which is 15 lakh rupees you paid, minus pre-acquisition dividend, if any. There is no pre-acquisition dividend. This dividend which you have here, no, 1 lakh rupees of dividend, this is whether this is pre-acquisition dividend or post-acquisition dividend. How will you find out? So you have to see this dividend was paid for the year ended 31st March 2002. And when did we invest? This was given. So this was given for 31st March 2002 and we invested on 1st April 2001. So we invested on 1st April 2001 itself we had invested, and this was given on 31st, and this was related to 31st March 2000. That means it is after we have invested. So after we have invested means this is a post acquisition dividend only. After you have invested only, this dividend is relating to. It is relating to the profits which are earned after the investment has been done. Okay, I hope you understood this. So this is a post acquisition dividend. That means pre acquisition dividend is 0. So your cost of investment is 15 lakh rupees. From that you have to reduce what was your share of net assets. So your share of net assets was how much? It was 16 lakh into 45%, which was nothing but 7.2 lakh rupees. So you do minus 7.2 lakh rupees. So you get 7.8 lakh rupees, which is nothing but your goodwill. And this is what they have shown here, 7.8 lakh rupees. Fine. Now, after doing this, you have to find out what is the carrying amount of investment. That is what they've asked in the question. So how do we find out this? So for this, what you have to do is you have to follow this format for it. Okay. So here what you have to do, you have to first take what is the share value of net assets plus goodwill. You will get your cost of investment. This is nothing but directly what you have taken. You have done in the above step, what you have done cost of investment minus share in value of net assets, you got your goodwill. Now do the reverse calculation. Take the share of value in net assets, add the goodwill and get the cost of investment. First do that. You should not directly take cost of investment. Okay, you have to do these both steps and only show it is a presentation that ICI does. So do the same thing when you are finding out the carrying value of investment. Once you have done that, in that you have to add or less any profit or loss which you have earned during the year. So you had already invested a certain amount. Suppose you have invested 15 lakh rupees, and during the year you earned some profit from the associate. So that add it. If you have got any loss, reduce it from your cost of investment. And then if there is any post acquisition dividend, reduce it. Why do you reduce post acquisition dividend? You reduce the post acquisition dividend because from the profits you must have got, instead of giving you that profit share, they announce dividend. Instead of giving you that profit share, they announce the dividend. So you decrease it. Okay, if it was profit, you would increase it, but instead they gave dividend, so you decrease it. Okay, so after doing that, you found out the carrying amount of investment. So if you see here, your carrying amount of investment. So first they are done. They have taken share in value of net assets, which was 7,20,000, added the goodwill 7,80,000, and found out the cost of investment, which was 15 lakh rupees. In that, during the year, if there was any profit they took there, during the year, if they had paid any dividend, they had lessened it. See, less post acquisition dividend, then they found out the carrying value of investment. So during the year, we earned a profit of 3 lakh rupees, which is given in the question. See, 3 lakh rupees of profit you earned and dividend of 1 lakh you have given. So in the 3 lakh, how much is our share? 45%. So 1 lakh 35,000 is our share. So our investment amount will increase by such profit, but dividend you had paid out. Okay, so 1 lakh rupees into 45%. So 45,000 of dividend has been paid out of it. So you reduce that. So you will be remaining with 15 lakh 90,000 rupees of carrying amount. Okay, so this is how you found out the carrying amount. I hope you understood this question. Okay, let's move on to the next one, which is nothing but a few cases are given. Okay, let's quickly go through it. Here there is A Limited, which is holding 22% in B Limited. Okay, and then the cost of investment was 33,000, which means A paid 33,000 to get a share of 22%, and the total equity of B was 2 lakh rupees. So here they are saying A is there, in B it has got a share of 22% by paying 33,000 rupees. Instead B has given it a share of net assets. And how much is the share of net assets? So here their total equity is 2 lakh rupees. So net assets is totally 2 lakh rupees. In that it has got a share of 22%, which means it has got a share of 44,000. See here, if you see, I told you, first take what is the cost of investment. Your cost of investment is 33,000 minus what is your share in the net assets, which is 44,000. So here you get negative 11,000, which is nothing but your capital reserve. Okay, the same thing I taught you in the concept notes also, if you see. Okay, so here you see cost of investment minus share in value of net asset. If it comes in negative, it is capital reserve. That means nothing. In simple terms, you may understand that you paid only a cost of 33,000, but you got an extra share of 44,000. So 11,000 rupees, you got an extra share. So that is nothing but your capital reserve. Okay, so this is what they have shown it as a balance sheet extract. How do you have to present a balance sheet extract? That also I taught you. Yes. So here, if you see down in your notes, I thought you right. So here, balance sheet extract, you will first take the share of net assets plus or minus profits and plus or minus goodwill or capital reserve. So first you have to take the share of net assets, which is 44,000, plus or minus profits you will do that you do not have, plus or minus profit or loss that you do not have. So directly we take less plus or minus goodwill or capital reserve. So you do less capital reserve and get 33. So directly 33,000 cost you should not show in balance sheet. You have to make all these break up and show that 44,000 was net assets, capital reserve was 11,000. So usually the shareholders like to see whether you have got a capital reserve out of that investment or goodwill out of that investment. So for that we make this presentation. Okay, next is case number 2, where they tell you that again it's similar. A Limited is holding 22% in B Limited. Cost of investment was 55,000. Total equity was 2 lakh rupees. So your cost was 55,000. Your share in net assets, less share in net assets, was 2 lakh into 22%. 22% was the investment, which is 44,000. So 11,000. So which means it is coming in positive, which means it is a goodwill. Okay, so here what happened? You paid a cost of 55,000, but you only got a share of net assets worth 44,000. That means 11,000 you paid extra. Why did you pay extra? To get the goodwill. So that will be your goodwill of 11,000. How do you show it in your balance sheet? You first show the share of net assets worth 44,000. Then you add or less any profits which is there, which is not there. So now you directly add or less goodwill or capital reserve. You do that of 11,000, and finally you show a cost of investment of 55,000. You could directly show this, but you should not. You should show a breakup that 44,000 was my share in net assets and 11,000 was my share my goodwill. So due to which I paid 55,000. Okay, I hope you understood this. Okay, next let's move on to the next example. Next example, which is A Limited was having a 10% stake in B Limited on April 1. During the start of the year, it had 10% stake. Then further 15% on October 21. That means, see, there is April, then after 6 months, that means on October starting. After 6 months, here there is 6 months. On October start, it got another, it had 10% stake. Here it got another 15% stake. Okay. So they are saying that the cost of investment, how much it paid for getting the 10% stake is 1 lakh rupees. It paid 1,45,000 to get that 15% stake. And the net assets on when it got 10% was 8,50,000, and when it got 15% was 10 lakh rupees. So now you have to find out what is the goodwill or capital reserve. So here what happened, a step up acquisition has happened. Already it had 10%, then it got another 15%. So first it had acquired some part, then again it acquired some part. Okay, so here earlier it had 10%, now it got 15%, so now it has become 25%. Now it means it is an associate with more than 20% holding. Okay, so here now you have to calculate the goodwill or capital reserve. So here what happens, when I told you in my concept notes, I taught you a point where I told you that, see, here if additional stake is acquired in an already invested company, already you had 10% share, now you had additionally purchased a stake of 15%. In such case, the goodwill or capital reserve which you are going to calculate, right, on both the acquisition date. So when you acquired 10% also, you will find out the goodwill or capital reserve. When you acquired 15% also, you will again find out the goodwill or capital reserve. That both should be shown after netting off. So first you have to net off and show both. Okay. Yes. So first let's do the calculation. So here calculations for April 1 you will do. So on April 1, what happened? You invested how much? You invested 1 lakh rupees. That was your cost of investment. Let's take this out so it's easier for us. Yes. So on 1st April, you acquired 10%. You paid 1 lakh rupees to get it. So cost of investment was 1 lakh rupees. And then you got a share in net assets of 8,50,000 was the total net assets. So in that 8,50,000, you got a share of 10%. Okay. So you paid 1 lakh. You got a share of instead 85,000 in it. You got a share of 85,000. So you paid more and got less. Why did you pay more? To get some goodwill. So goodwill will be 15,000 rupees. So this is how you normally find out. This is easy. Again on October 1, you have to find out what was your cost of investment. Your cost of investment that you paid was 1,45,000 you had paid. How much share you got in net assets? 10 lakh was the total net assets on that date, in which you got 15% share. So 1,50,000 you got share. You paid 1,45,000, but you got more share in net assets, which is 1,50,000. You paid only 1,45,000, but you got how much? 1,50,000 worth of net assets. So 5,000 you got extra, which is nothing but your capital reserve. So here now, if you see, earlier we had a goodwill of 15,000, then we got a capital reserve of 5,000. So earlier you had a goodwill of 15,000, then you got a capital reserve of 5,000. So net off you have a goodwill of 10,000. Net off you have a goodwill of 10,000. Okay. So this is what they have given here. I hope you understood. Then the next case is also like that only. A Limited had acquired 10% first, then 15% next. Cost of investment and net assets they have given you. Okay. So on April 1, what will be the cost of investment? How much they had paid for the 10% stake? 1 lakh rupees they had paid. So 1 lakh rupees you will take. And then what is your share in net assets for the 10%? 8,50,000 into 10%. So 85,000 will be your share. So you paid 1 lakh rupees but got only a share in net assets worth 85,000. That means you have got 15,000. That means you have paid 15,000 extra. Why you paid 15% extra? Sorry, 15,000 extra for the goodwill. So goodwill will arise on April 1. Then again on October 1, what will happen? You invested how much? 1,55,000. See, you paid in value of 1,55,000 for 15%. And then how much share in net assets you got? Share was totally 10 lakh rupees. In that you got 15 percentage, which means you got 1,50,000 worth share of net assets. So you paid 1,55,000. Share of net assets was just 1,50,000. That means 5,000 extra you have got. Sorry, you have paid 5,000 extra. 1,55,000 you paid, 1,50,000 you got. So 5,000 you paid extra for what? For the goodwill. So now here you do on October 1, there was a goodwill of 15,000. Again on, sorry, on April 1, there was a goodwill of 15,000. Then again on October 1, there was a goodwill of 5,000. So totally you have a goodwill of 20,000. So that is what you will show in the year end. Total goodwill worth 20,000. Okay. So for this case 3 alone, I'll upload a separate video in a few days. You can see that video to understand this concept of further acquisition and associate in the same year. Okay, I hope you understood this. Case 3, I'll teach you later on. Okay, now let's move on to illustration number 2, which says that there is A Limited which acquired 40% in B Limited for 10 lakh rupees. Okay. And then B Limited had 1 lakh equity shares of 10 each fully paid. Wait, let's go step by step. So first what they are saying that there is A Limited and it has acquired 40% in B Limited and it has given 10 lakh rupees to get that. Cost of investment is 10 lakh rupees. Okay. Or we can say amount paid to get that investment is 10 lakh rupees. On that same date, B Limited had 1 lakh equity shares of 10 fully paid. So it has 1 lakh equity shares of 10 fully paid, which means 10 lakh rupees of equity share capital it had, and it had an accumulated profit of 12 lakh, 2 lakh. 2 lakh rupees of accumulated profit. If you add these both, it will be 12 lakh, and 12 lakh is nothing but your net assets. It's nothing but the net assets of B. It is nothing but net assets of B. Okay. Then they are saying that in year 1 2 they are giving 3-year data. In the year 1 2, that is during the year of investment, in the next year of investment, which is 2 3, and then the next year, which is 3 4, in that year data they have given. So first let's first do this on the date of acquisition. What has happened, let's first understand, then we'll see the further data. So first let's calculate goodwill or capital reserve. They are telling you in the question that you have to make an extract of consolidated balance sheet on all the 4 dates. 4 dates means here on the acquisition date you have to do, then on the 1 2 year end, in the 1 2 year end you have to find out, in the 2 3 year end you have to find out, in the 3 4 year end you have to find out what is the extract of balance sheet. So let's first start with the acquisition date. So here what happened, first you will see what is your cost of investment. Your cost of investment is 10 lakh rupees. That means you paid 10 lakh rupees to get that 40% share. In that, how much you got in net assets? Your net assets was worth 12 lakh rupees, like we found out above. Here we found out, right? So it was 12 lakh rupees. In that 12 lakh rupees, your share was 40%. So which means it was 4 lakh 80,000. So you paid 10 lakh rupees, but you got a share of net assets worth. So you paid 10 lakh rupees, you got a share of net assets worth 4 lakh 80,000 rupees, which means 5 lakh 20,000 rupees positive figure was the difference, which means it is nothing but your goodwill. So you got a share of 4 lakh 80,000 only, but you paid 10 lakh, which means you paid extra. So you paid extra for what? For getting the goodwill. So goodwill of 5 lakh 20,000 you have got. Okay, so this was as on the acquisition date. So what will be your extract of balance sheet on acquisition date? What did I tell you? How will you show? You will first show the share of net assets, which is 4 lakh 80,000, which is just found out here, right? So this was 4 lakh 80,000. And then you will do plus or minus any profit or loss, which is not that. Then you will do plus or minus any goodwill or the capital reserve. So we had a goodwill of 5 lakh 20,000. So take that 5 lakh 20,000. So if you add these both, 10 lakh rupees will be your cost of investment, which you will show in your balance sheet, which you will show in your balance sheet. Okay. Next is on the year end of 1 2, on the year end of 1 2, which means 31st March 2002. On that date, what happened? B suffered a loss of 10 lakh rupees. Let me take a different color. So they are saying B suffered a loss of 10 lakh rupees. Okay. So what you will do when you are showing, so when you are going to show your extract of balance sheet, what you'll do, you will take the share of net assets again. Your share of net assets will not change, it will remain the same. What was there on your acquisition date, it's going to remain the same only. So it is 4 lakh 80,000. Your goodwill also remain the same only, 5 lakh 20,000. What will come extra here is that if during the year, if there was any profit or loss which you have earned, only that will increase or decrease. So you had got a loss, so loss will be reduced. So loss will be reduced. So loss of how much you had got a loss of 10 lakh rupees. Let's go above and see once. It is a loss of 10 lakh rupees. See, if you see here, you have got a loss of 10 lakh rupees. Fine. So it is going to be 10 lakh into our share is how much? 40%. So 10 lakh into 40%, 4 lakh rupees you will reduce. So it is 4 lakh 80,000 minus 4 lakh plus 5 lakh 20,000. So 6 lakh rupees will be your investment in associate or your carrying value as on the balance sheet date of 31st March 2002. So next year end, let us see. So next year end, what has happened? As on 2 3, what has happened? Again they have incurred a loss of 12 lakh 50,000. Again they have incurred a loss of 12 lakh 50,000. So how will you show this again? So let's move on to the next year end. So here again you have to show the share of net assets, which is 4 lakh 80,000 to remain the same. Goodwill will remain the same for 5 lakh 20,000. Only there will be a difference in the plus or minus of profit or loss. So loss, how much we have got this year? This year we have got a loss of 12.5 lakh rupees. In that our share is 40%. So 12 lakh 50,000 into 40%, it is nothing but 5 lakh rupees. So here how will you show? Earlier you had a loss of 4 lakh rupees. This year you got a loss of 5 lakh rupees. So totally 9 lakh rupees is your share of loss. So yours will 4 lakh 80,000 worth of net assets. So 4 lakh 80,000 worth of net assets, 9 lakh worth of loss, which you will minus. So 4 lakh 80,000 minus 9 lakh plus again goodwill of 5 lakh 20,000 rupees. So 1 lakh rupees will be your net figure, which you will show in your balance sheet, Okay. Yes. So let's move on to the next case, which is the last year end. So in that, what happened in the year 3 4, again you get a loss of 5 lakh rupees. Again you get a loss of 5 lakh rupees. This case is very very important. Listen to it carefully. Okay. So here, when you come on 31st March 2004, so here what happens when you drop the balance sheet? So when you drop the consolidated balance sheet, so it will be, you'll show your share in net assets is 4 lakh 80,000, your share in goodwill is 5 lakh 20,000. That will not change. I just told the profit or loss figure is going to change, so profit or loss figure will change. So already you had a profit loss of 4 lakh and a loss of 5 lakh rupees. That means your share of loss in the first year was 4 lakh, in the second year it was 5 lakh. In the third year, your share in loss would be, so how much is the loss in the third year? In the third year, the loss is 5 lakh rupees. So 5 lakh into 40%, your share in loss is how much? Let's do this. 5 lakh into 40%. So your share in loss is 2 lakh rupees. Share in loss is 2 lakh rupees. Okay. So if you do your share in loss is 2 lakh rupees, then what will happen? Here, if you, instead of 1 lakh, if you do share in loss of 2 lakh rupees, it will be 4 lakh plus 5 lakh plus 2 lakh. It is going to be 4 plus 5, 9, 9 plus 2, 11 lakh. So if you see 11 lakh rupees, if you do, then it will be 4 lakh 80,000 minus 11 lakh rupees and then 5 lakh 20,000 rupees. So how much will that be? Let's calculate. 4 lakh 80,000 minus 11 lakh rupees plus 5 lakh 20,000. So you'll get a negative figure of 1 lakh, and your investments in your book can never be negative. It cannot be negative. So what you do is, instead of reducing 2 lakh rupees from here, you only reduce 1 lakh rupees from here, so that your end value comes as nil. The end value comes as nil. What will we do about the remaining 1 lakh? So 2 lakh rupees of 1 lakh you charge in the balance sheet and then brought your carrying amount to 0. Carrying amount cannot be negative, so you bring it to 0. So you bring it to nil figure. I hope you understood this part. Now the remaining 1 lakh rupees of loss, what we'll do, we'll charge it to the P&L account. In the question, they have not asked about it, but I'm telling you, the 1 lakh rupees of loss, you'll charge it to P&L account. So in the next year, if you get any profit, right? Next year, if you get any profit, that profit you will not directly take it to the carrying amount and increase your carrying amount. You will not do that. Suppose you have next year, you've got a profit of 3 lakh rupees. In that first, this 1 lakh rupees of loss you will adjust, and only the remaining 2 lakh rupees of loss you will adjust to your carrying amount. So let me repeat this again. In the current year, what has happened? In the current year, if you take the loss directly, you will get a negative figure of 1 lakh rupees as carrying amount. You cannot have your carrying amount as negative. So what you do is, only 1 lakh rupees you reduce from here and you show your carrying amount as nil. So in the loss of total 2 lakh, only 1 lakh we were able to adjust. The remaining 1 lakh, what we'll do, we'll charge it to the P&L account. Okay. So this is the case until now. Now I'm saying, in the next year, if we get a profit of 3 lakh rupees, directly don't take it to the carrying amount and increase the carrying amount. Don't do that. Okay. Don't do that. Don't do that. Okay. What you have to do instead is, you have to first, in this 3 lakh, the 1 lakh that you charge to PNL, first adjust that. The remaining 2 lakh you can go and add back to your carrying amount. You can increase your carrying amount. I hope I made this clear. This case is not there, but I'm just explaining what will happen in case if it comes. Okay. So this was all your illustrations and your examples. Now let's move on to your test your knowledge question. I'll do the practical part alone. So here in the illustration number 1, you can directly read. It's a normal theory question. Let's start with MCQ number 2. It says that there is A Limited. It is holding 90% share in B Limited. Okay. So there is A Limited which is holding 90% share in B Limited and then 10% share in C Limited. So this is holding 10% share in C Limited and B Limited is holding 11% share. And this is same as what we read in our example number 1, I think. Okay, 11% here. So they are asking, which of the statements are incorrect, you have to find. Which of the statements are incorrect, you have to find here. Okay. So first they are saying A is the parent of B. Yes, the answer is correct because A is holding 90% in B. A is the parent of B. A will be the parent, B will be the subsidiary company. This statement is correct. Second statement, they are saying that A Limited and C Limited is concerned. A Limited has a direct and indirect holding of 19.9%. The answer is wrong. This is in the case of CFS, but in the case of SFS, how will you find out? You will find out that how much is A holding in C Limited. A is holding 10% in C Limited. So this is direct holding. Now, how much is B Limited holding in C Limited? It is holding 11%. So plus 11%, which means 21%. So in SFS, it is 21% holding. So the second statement is wrong. Okay. Here, if they would have written CFS, then we could have agreed to this statement. But here they did not mention anything, which means it is 21% share in SFS. So this statement is wrong. And finally, C Limited is an associate of A Limited. Yes, because 21% it is holding in C Limited. A is a associate of C Limited, or C is an associate of A Limited. So this statement is correct. So the statement 2 is incorrect, which is the correct option. I hope you understood this. Then in the next case, these two cases which are here, these two cases are similar to what we had already studied above. Okay, so you could just take a screenshot of this or pause this and see how I have solved this and solved in the same way. So there's nothing but first it had 10% stake, then it got 15% stake, and then what happened? First you got a goodwill of 15,000, next you got a goodwill of 5,000, so total goodwill is 20,000. Here also same, first it had 10% stake, next it got 20%, 15% stake. So first it had 15,000 goodwill, then it had capital reserve of 5,000. So netting it off, your net goodwill is 10,000. So net goodwill is 10,000. That is the answer. This you have already done, so I am not repeating it. And these are all practical, theory questions. So I am not repeating that. Let's move on to your practical question, which is question number 8. So you have two practical questions, which is question number 8 and question number 9. So if you do these both, your sums video will be complete. Okay. Yes. So now let's start with our illustration number 8. I've drawn a timeline here for easier reference for us. So first they are saying that there is Bright Limited, and Bright Limited is holding 30% in East India Limited. Okay. So Bright, what is Bright holding in East India? It is holding 30% in East India Limited, and it had got it for 2 lakh rupees, shares for 2 lakh rupees. It had got it for 2 lakh rupees. Okay. And on what date did it get it gotten? 1st June 2001. 1st June 2001. So I've made this timeline here that on 1st June 2001 it had acquired 30% in East India Limited. So here I have made that on 1st June 2001, 30% it had acquired, 30% it had acquired. Okay. Then next, let's read the remaining question. Then they are saying by doing this, they got a significant influence. Of course, it is correct. 30% means it is more than 20 percentage. It is more than 20 percentage, which means it would have got a significant influence. Until now, I hope everything is clear. Next, they are saying that on 31st March 2001, 31st March 2001 means here on this date. Okay. So they are saying that on this date, what happened? They had earned a profit of 80,000 rupees. So they had earned a profit of how much? 80,000 rupees, and declared a dividend of 50,000 on 12/8/2001. That means here they are saying that on 31st March 2001 they earned a profit of 80,000. Okay. And on 12/8/2001 they declared a dividend of 50,000. That means they have declared this dividend from the profit pertaining to 31st March 2001. So from this profit of 80,000, they have declared a dividend of how much? They have declared a dividend of 50,000 here. I hope you understood this. That means we have invested when? We have invested on this date. So any profit which is, or any dividend which is declared after this, not declared after this, I mean any dividend which is related to the profits that we have earned after this period will be our post acquisition profit. But if there is any dividend which is declared from this profit, this will be a pre acquisition dividend. Why a pre acquisition dividend? Because at that time we were not an investor. Okay, from the time where it earned 80,000 profit, we were not the investor at this time period. We became the investor after this only. So out of the profit of 80,000, if 50,000 dividend has been declared on 12/8, then in such case, this is what? This is nothing but our pre-acquisition profit. So this is nothing but a, pre-acquisition dividend. So this 50,000 is a pre-acquisition dividend. I hope you understood until now. Next, they are saying, so that is the information that they have given. Let's erase this. Yes. Okay. So I hope you understood until now. Fine. Okay. Next, what they are trying to say is, then they are saying that East India reported earnings of 3 lakh for financial year ending 31st March 2002. Then they are saying 31st March 2002, 31st this year, 31st March 2002, they earned a profit of 3 lakh rupees, and from that they declared a dividend of 60,000 on 12/6/2002. So on 12/6/2002, they declared a dividend of 60,000. Okay. So from this profit, they declared a dividend of 60,000. Here we were already an investor. On this day, we were already an investor. So this will be our post acquisition. So this will be a pre acquisition dividend, and this will be our post acquisition dividend. I hope you understood this. So let's understand the timeline once again. So this was the date when we invested. Before this, they have got from profit. Out of that profit, they had given some dividend here. And then again, during the year end, we earned some profit. And out of that profit, they have given dividend again. So this is our timeline. So I hope you understood this. Fine. So now in the question they are asking you that you have to first calculate the carrying amount of investment. As in separate financial statements you have to calculate, then in consolidated financial statements you have to calculate both on the year ending 31st March 2002, 31st March 2002. That means as on this date, 31st March 2002, as on this date you have to calculate what is our carrying amount of investment. Okay, in SFS and CFS. So first let's do these two and then we'll see what the further question is asking. Fine. So let's move on to that. Okay. So in SFS, in a separate financial statement on 31st March 2002, what will be our amount, carrying amount? How do you find out carrying amount? How do you find out carrying amount? What did I tell you? What was the formula? Or what was the format of finding out carrying value? So it is nothing but for share in value of net assets plus goodwill. If you do, you will find out the cost of investment. But before doing this step, make sure to find out the goodwill or capital reserve first and then come to this step. After that, you have to find plus or minus profit or loss that you have earned during the year minus any post acquisition dividend. You will find out your carrying amount of investment. Okay. So first, what we are going to do? First, you are going to find out goodwill or capital reserve, and then we are going to do this step here. Okay. Okay. So let's start. So first we are going to find out what is our goodwill or carrying amount. Okay, so first what is our goodwill or capital reserve? So first you have to start with what is the investment amount that you have paid. In the question we read that we had paid 2 lakh rupees. We had paid 2 lakh rupees to get the 30% share. Okay, in that did we get any pre-acquisition dividend? The answer is yes, we got a pre-acquisition dividend. Pre-acquisition dividend of how much rupees? You have got a pre-acquisition dividend of 50,000 rupees. This 50,000 rupees is not entirely ours. In this only 30% stake we will get. So 50,000 into 30%, 15,000 rupees you got as pre-acquisition dividend. So that you will reduce from your investment amount. That you will reduce from your investment amount. So from this 15,000 if you reduce, so your cost of investment will be how much? It is going to be 2 lakh minus 15,000, which is 1 lakh 85,000. Okay. And in this, if you reduce your share of net assets, in this, if you reduce your share of net assets, you will get your goodwill or capital reserve. But in our question, this part is not given. I think share of net assets, that related data is not given in the question anywhere. Okay, so what we do, we are not going to do anything about it. So we'll stop it here itself. So we'll stop it at cost itself, which is 1,85,000. Now you have to find out what is the carrying amount. What is the carrying amount in SFS? So your carrying amount in SFS is nothing but 1,85,000 only. So carrying amount in SFS is 1,85,000. In your concept notes, see in your concept notes, this cost of investment which you find out, no? This cost of investment which you find out when you're finding out the goodwill, when you're finding out the goodwill or capital reserve, the cost of investment that you get here is nothing but what should be your carrying amount. It is nothing but what should be your carrying amount in SFS, carrying amount in SFS. So here also this cost of investment is nothing but your carrying amount in SFS. Okay. From this now if you find out the carrying amount of investment, this carrying amount of investment will be nothing but your carrying amount of investment in CFS. So here what I am trying to tell you is that, so here when you're finding out, calculation of carrying amount of investment, in that this carrying amount of investment only I told you will come here also. It's the same thing only. So this is nothing but carrying amount in SFS. Now if they tell you find out carrying amount in CFS, you have to do plus or minus your profit or loss minus your post acquisition dividend. By doing this, you'll find out your carrying amount of investment in CFS. Okay. So from this, what you have to do now is, so carrying amount in the CFS will be nothing but you have to take your carrying amount as per separate financial statement, which is 1,85,000, which is cost of investment, which we found out. In that you have to add or less what is your share of profit or loss. Add or less your profit or share of loss, and then you have to lessen your post acquisition dividend. You have to less your post acquisition dividend. Okay, fine. So now let's go on and see what was a profit or loss. Fine. So as on 31st March 2002, we earned a profit of 3 lakh rupees. We earned a profit of 3 lakh rupees. Here before that, there was no post acquisition dividend. The post acquisition dividend was taken after that only. So for now, we will not take into account the post acquisition dividend. So as on 31st March 2002, our profit was 3 lakh rupees. We had earned a profit of 3 lakh rupees. So in that, what was our share? But wait, before that, I forgot to tell you one thing, that you had invested on when? You had invested on June only. You had invested on June, and this profit of 3 lakh rupees is related from April till March. So this is a 12-month profit, but you had only been in the company from June to March. You had only invested from June to March. That means April, May. 2 months of profit you will not get, only 10 months related profit you will get. So total profit is 3 lakh rupees. In that your share is how much? Your share is 30 percentage. In that also only 10 months share you will get, 10 by 12 months. This I had written as a question point also. Here if you see in the notes below, I've written it as a question point also, where I've said, see, if the investment is made for less than 12 months, then in such case you'll take PNL during the year, multiply by your share, multiplied by the number of months you have invested. So number of months you have invested is only 10 months. So do this, 3 lakh into 30% into 10 divided by 12, it is 75,000. So your share is 75,000. So you will do that. You will add your profit share in that carrying amount in SFS. So you had already found out carrying amount in SFS is 1,85,000, 75,000 share of profit you will add. So your total will be 2,60,000, which is your carrying amount as per your CFS. Carrying amount as per your CFS. Okay. I hope you understood this clearly. Fine. So this was your second. Now let's move on to the third one, where they ask you that, where they tell you that what will be the carrying amount as on 30th June 2002 in CFS. Usually you don't do this. You only find it at year end. But now here they have asked in mid of the year itself. So here as on, they are asking as on 30th June to what will be your carrying amount. Here what will be your carrying amount. So here what has happened from 31st March. Yes. So from 31st March to 31st, sorry, 30th June to, only one extra transaction has happened, which is your post acquisition dividend of 60,000 rupees. So now that adjustment alone, if you make, it will be proper. Okay. So carrying amount of investment in consolidated financial statements. So your carrying amount on 31st March was 2,60,000, which you wrote from here. Then carrying amount on June will be how much? You have to less your, so you have to add or less any profit or loss you have earned, and you have to less your post acquisition dividend. So your post acquisition dividend was 60,000, that your share was 30%. So if you do this, 18,000 will be less, and your carrying amount will be shown as 2,42,000. 2,42,000. Okay. So this is how you have to do your question number 8. I hope there is no other doubts in this. Let's move on to question number 9. In question number 9, they tell you that there is A Limited which has acquired 25% in B Limited. So there is A Limited, it has acquired 25% in B Limited on 31st March 1 for 3 lakh rupees. So it has given 3 lakh rupees to acquire the 21% and the 25%, and they are saying the balance sheet of B Limited is given here. So this is a B Limited balance sheet. So they have given share capital reserves and surplus. Total is 10 lakh rupees. So this is nothing but what? This is nothing but your net assets. So let's find out our share in net assets. A share in net assets is 10 lakh into 25 percentage, which is equal to 2.5 lakh rupees. So here you had your cost of investment was 3 lakh rupees. You had a share of net assets of how much? 2.5. So here your goodwill is 50,000 rupees. So here you have got a goodwill of 50,000 rupees. We don't know what has been asked in the question, but we are able to find this. Okay. Then they are telling that additional information is given below. So this was as on 31st March 2001. Next, they have given additional information as on 31st March 2002. Okay, that means 1 year later they have given this additional information. They are saying that A Limited has received dividend from B Limited for a year ended 31st March 2001 at 40% from the reserves. So at 40% they have received some dividend. Okay, so this is a point about dividend. Then they have told that B Limited had made a profit after tax of 7 lakh rupees for the year ended 31st March 2002. So here they are talking about some profits, and then they are saying that B Limited had declared a dividend of 50% for year ended 2002 on 34 2002. Okay. So again, they are talking about dividend here. We'll classify the data even more. Like they are talking about dividend here, profit here, and dividend here. Okay. Now, what they're asking the question is, it is preparing a consolidated financial statements for its various subsidiaries. Calculate goodwill. First, you have to calculate goodwill. Let's segregate the data now. So in the first point, they had said they had received a dividend from B Limited. A Limited has got a dividend from B Limited for the year ended 31st March at 40% from the reserve. So for the year ended 31st March, so this is the time when we invested also. That means if for this time again, if they are announcing a dividend, that means this dividends profits, where it is coming from what will they be announcing it? From the reserves which are made in the past. So from the 40% of the reserves which are made in the past, they are announcing dividend. The reserves was at 5 lakh. So 5 lakh into 40%, they announced a dividend of totally, it is 5 lakh into 40%, 2 lakh rupees dividend they announced. And this reserves was not after we entered, we created. This was already there from the past. So out of the 2 lakh rupees reserves that way, announced, which was from the past profits or past reserve, this will be called as a pre-acquisition dividend, because at that time we were not the investor when we earned this reserves of 2 lakh rupees. So in that, our share is how much? Our share is 25%. So 2 lakh into 25%, which is 50,000 is our share. So now let's calculate the goodwill now that we have a pre-acquisition dividend. Can yes. So how much amount we paid towards acquisition? We paid 3 lakh rupees. Our pre-acquisition dividend we have to less from it, which we found out was 50,000 rupees. So we'll get a cost of investment at 2.5 lakh. From this also, our share of net assets we have already found out. Our share of net assets was how much? It was 25% of 10 lakh rupees. We already found this at 2.5 lakh. So our goodwill is nil. So our goodwill is nil. I hope you understood this question. This we have already calculated above. Okay. Next they are asking, how will A Limited reflect the value of investment in the consolidated financial statements? How will you reflect it in the consolidated financial statements? That means they are asking that in your P&L, how are you going to show it? Then in your balance sheet, how are you going to show it? Okay. So let's go and see our consolidated P&L account. So let's go and see our consolidated P&L account and consolidated balance sheet. So consolidated P&L account, how you have to make? I've already told you, right? So if you come and see your concept notes, P&L account, what you have to do? First, you have to take your share of profits in the associate, that you have to show separately. And then what you have to do? Whatever your pre-acquisition dividend was there, that you have to show. From that, show it as transferred to investment, and then your final balance will be nil. Then your final balance is going to nil. So these two figures you have to show under other income. So let's go under other income. What they have done under other income, they have shown first share of profits of B Limited. So share of profits, what was the share in profits during the year? We earned a profit of how much? We earned a profit of 7 lakh rupees. In that 7 lakh rupees, our share was how much? Our share was 7 lakh into 25 percentage. Let's see what it's coming up to. It's coming to 1,75,000. So this will be 1 point. After that, you will show this is A, then you will show B as pre-acquisition dividend was 50,000 rupees that you transfer to investment account. So minus 50,000 rupees, and this will come as nil. So this was your presentation of P&L account, which you have already understood. Then let's come to the presentation of consolidated balance sheet. So you have to show under non-current investments. This you have seen so many times now. So let's be quicker with this. Okay, first you have to show here, what you have to show is how much is your share in net assets. So how much is your share in net assets? First you have to show your share in net assets was 10 lakh into 25 percentage is 2 lakh 50,000. So it is 2 lakh 50,000 plus or minus the profit or profit or loss that you have earned during the year, which is 1,75,000, and plus the goodwill that you have earned, which is nil, plus or minus the goodwill or capital reserve. So that is nothing. So 2,50,000 plus 1,75,000, 4,25,000 is your total value that will be shown in your consolidated balance sheet. Okay. So I hope you have understood this question also. Then finally, they are asking in the point number C that how will be the dividend received from B Limited will be shown in the consolidated financial statement. So if you've seen the working notes, see, we are saying that the pre-acquisition dividend which was received from B Limited amounting to 50 lakh rupees will be reduced from the investment value. That means this is a pre-acquisition dividend. So they are saying the pre-acquisition dividend you will reduce from the investment value. Okay. And then the dividend declared on 30th April, which is your post-acquisition dividend, it will not be recognized in the consolidated balance sheet. Why will it not be recognized? Because you are making financial statements of 31st March 2002. So this was declared only on 30th April. That means even though it is a post-acquisition dividend, it was declared after this date only. So as on 31st March, it will not be shown in your balance sheet. Okay. So if you see here, let's go to the question so you understand it better. See, so it was declared on 30th April. It was related to 31st March, but it was declared on 30th April only. That means it will be given to us afterwards only. So after the financial year end only. So during the financial year end, you will not show anything in your financial statements. Okay. So I hope you understood this question. So this was all your question. That one case that I had left, I'll upload it later on. So until now, if you have watched, if you found this helpful, please make sure to like, share, and also subscribe to the channel. And please make sure to leave a feedback down below about how you like the video, so others also get benefit from it. Thank you so much.